So good afternoon, everybody, to our monthly CIO call. Today's agenda got a bit mixed up due to yesterday's correction. So we will cover the correction and answer the question by the dip. As usual, I will go through macro, through the bond, in particular high yield in China. We'll say some words, and then last but not least, we do see weaker eco data. What does that mean for equity? Shall you sell them due to weaker outlook, or shall you stay invested? And I will briefly probably touch as well on FX and some commodities. So the forward-looking PMI data across the globe were weaker. That's a key message, and it's quite annoying. As you can see underneath on the right-hand side, in Germany, the fourth largest economy in the world, ZEW and IFO are rolling over, indicating a significant slowdown. PMI data are as well rolling over. However, they are still in the acceleration area / above 55. If we turn to Japan, this is an area where the market has performed pretty well. You can see that the PMI data was below 50 and they had a significant slowdown. But now the second derivative, which is the slope of the orange line, is upward sloping. That means that forward-looking an acceleration of growth is expected. Similar in the US, I mean, just looking at the graph, you see that the PMI data is significantly falling. However, it's a bit misleading because the scale is on the left-hand side. And there you see that we are in most indicators still around 55. In the manufacturing area, we are still significantly closer to 60 than to 55. The next data point will be released this Friday, and it will be important to see where we stand. But even in the US, we have to admit that there is a slowdown. And if you follow the Fed talk and the ECB talk, both basically have stated we will only raise rates later. In the case of the Fed, later maybe in 2022, but rather in 23, and the ECB rather in 2024. However, if you have a slowdown, they should in theory decrease rates, which they cannot, given that we are at zero. Therefore, it is fair to say that both central banks are behind the curve, different to a lot of smaller countries. The last one who has just risen for the third time this year rates was Brazil. Turning to real data to get a feeling of where we stand. On the right-hand side, you see the absolute export levels. They were down 5% in August, and April was the peak. But if you look at the bar charts, it is fair to say we are at an extreme high level still, almost at all-time high. While on the left-hand side, the same data is stated in a different way. It shows you year-over-year growth, which is obviously misleading given that we had lockdowns last year. But you can see that with both graphs, you can paint a complete different picture. One is of a strongly decelerating economy, and the other one is one which there is a bit of less accelerated growth, but we are still at significant high levels. But what's the key message here underneath is, although we do see slower data, the equity market was up roughly 15 to 18%. This was yesterday morning. In the meantime, we are a bit lower, maybe 1 to 2%. But this is already a key thing for later on. A slowing economy does not mean that equities must go down. The big elephant in the room continues to be inflation. This time I've chosen this chart, which basically shows you expectations in the market. They are all higher than the latest figures. So in Germany, CPI was last month at almost 4%, and for the Eurozone at 3%. However, everybody does expect down the road, which is in 1-2 weeks, that this figure will be much higher. And don't forget, depending a bit on how you measure it, but most of the time energy prices are excluded. And in Europe, we have a huge energy crisis, especially in the UK, where not only the gas price went through the roof, but also they have a shortage of petrol in the petrol station due to missing lorry drivers. Both has significant impact on rising prices, which is not reflected in the official data. The next key event which happened was that we have seen rising yields across the globe, roughly 20 bips. So in Europe, the government bonds are still below zero. However, in the US, you see that the 10-year yield is now roughly at 150. But if you look back in March, we were much higher. So the event is really minor, but it had some impact with other market events on markets, in particular on prices of equities and of bonds, which both collapsed. But if you add both together, you can still see that in Germany, the real yield, so after adjusting for core inflation, again, excluding volatile things like food and energy, we are below 3%. The picture in the US looks very similar, although the level is roughly minus 2.7%, given the higher starting point, but also the higher CPI data. For me, the amazing bit is rather this chart. We have seen no spread widening, or at least no significant spread widening in global high yields and in US high yields. However, due to the fact that both high yields and government bonds have risen, we see now higher yields in these markets, and obviously higher yields means lower bond prices. But the elephant in the room is this here. This is an index, a carve out of the China high yield market. The China high yield market has collapsed over the last 4 months more than 12%. And this is significant. And it's even worse if you try to trade certain sectors in China. You ask for a bond price, which is lower than what you see on the screen, and then you accept such a price and you want to execute, and then the broker who quoted you a price is even taking you away the quote. So this drop is not really reflecting the whole reality, because you cannot really sell everything you want to sell. The next consequence of all this, high inflation rate, no spread tightening, at least in the US and in most global markets, means that you see low real yields or negative real yields on junk bonds. This is definitely amazing. You get an equity risk and you get a negative starting yield when you invest. This is not a compelling investment. So turning to recent events, this slide I had last time. So what you can see underneath circled is the performance of each month of the year since 1928. And on average in September, you lose 1%. This is a bit counterintuitive, because the larger crashes we have in memory, like 29, 87 in 1998 and even 1999, it was rather October than it was September. But still, if you include all data, this month where we are still in is the weakest of the year. Doing a sanity or reality check, if you will, amazing is the Nikkei, but this is driven by the change in the government, and there will be a new prime minister. So excluding the Nikkei, you see that the S&P, that's the first line, is roughly down 3.8%. Switzerland is down more than 7%. Europe is down 4%. Then Nasdaq is down 5.4%. So the reality check, obviously excluding today, minor rebound, and not knowing what is going to happen tomorrow, is not so unusual. but it's a lot of turbulences and creates stress and questions. And the question obviously is, what will happen short term? And short term, you have to look at charts. And if you look at charts and you choose some which give you the story, here is the Swiss market. You see the recent reached low, i.e. last Monday a week ago, was yesterday not reached. By the contrary, we broke to the downside. And today's rebound is very muted, so it's quite likely that we might test the yellow line, which is the 200-day average. But for the Swiss market, similar for Germany, for UK, and a lot of other markets, the picture tells you that this correction, or it's rather a pullback, because so far we are talking of 4 to 8% max, is probably not over. If we turn to the S&P 500, I could make the case that we are now at the green line, which is the 100-day average. We have closed yesterday above last week's low. Today, at least the start was slightly positive, but the chart looks vulnerable. But just pure technically speaking, you see the spike in volume underneath. 1 week ago, you see a positive retest yesterday. Therefore, that looks pretty okay. However, if we turn to the Nasdaq, you see that also here, like in the Swiss market, the blue bar goes much below much below last week's low. Therefore, we have not successfully tested the latest low. So we are still in a downtrend, and probably we are going to test the green line, or maybe even the yellow one. And as the Nasdaq, or the components of Nasdaq, the funds are 25% of S&P, it is probably fair to assume that the S&P will as well test recent lows another time. So short term, I would expect more downside. Midterm, I have obviously a more differentiated opinion, and I can base my opinion more on facts and figures and not just on charts. You see here the fear and greed index. Last time we had our call, we were roughly at 50, so almost neutral. Today, this morning, we were in the fear area, and 1 week ago, when we had the sell-off, we were even in extreme fear. When this indicator is at such levels, it is extremely unlikely that we will see a real crash correction of more than 10-15%. It's rather an indicator that midterm we might mean reverse, like you see on the chart on the right-hand side. This opinion is supported by this survey done by UBS. Basically, they claim that the investment sentiment has dropped below 25%. If my memory is correct, it was 22 or 23%. And at the same time, the ISM PMI data, so the industrial area of the US, is still at 59.5. The next data point, as I said before, will be this Friday. But as long as this PMI data is above 53, and the sentiment of investor, or the fear, if you will, is below 25%, which is both the case, you see the forward-looking returns. So the dark bars are the most relevant ones. You see that over 12 months, on average, if such a situation has occurred, the performance was above 20%. If we include all periods, the average return, what a miracle, is exactly plus minus where you expect nominal return of an index around 10%. So also from that angle, that tells us that the likelihood that we see over the next 12 months positive return is quite high. This chart I had previously in my sets. I just included it once more. Basically, it's telling you when the PMI data drops from above 55 towards 50, or from peak to trough, to be exact. the return of the market is still positive only, that's on the right hand side, only if you go from 50 to trough to recession, the return on average is negative. So therefore, even from that angle, I would argue that the outlook is quite positive. But I must add again, if we were to fall towards 50 and the Fed is not going to react as they state that they will not react, we must expect that the Fed is out of ammunition, so they cannot cut rates because we are at zero, or as I would put it, they are behind the curve. And it will be interesting to see what comes next. And next, the most likely thing is you will see first a bit of tapering, that's announced, and then second, a new form of QE. I'm not the only one who says that. For instance, Ray Dalio has that said 1 week ago, roughly, in a Bloomberg interview. I would argue if this slowdown continues, as it looks like, then we will see next year another form of another QE program in the US. Having said that, the ECB also stated that they will cut back their PEP bond purchasing program, so the emergency part, but not the normal part. So they will continue to buy bonds until probably 2023, and they will not raise rates before that. But also in Europe, we do see that the PMI data and the forward-looking data, we have seen that ZEW, and we have seen as well the IFO, they are all deteriorating. Therefore, it is fair to assume that also the ECB will fall behind the curve, and they might be forced to push the economy with another measurement, be it with QE or be it with the help of the parliament and with some fiscal stimulus. But definitely both areas have a problem in terms of where the actual policy rate is and where the outlook of the growth is heading to. The good news, why I'm positive, we had that before, is that the consensus estimates of earnings is somewhere between 205 to 210. That gives an actual PE ratio of 21. And for 2022, the data is even higher. Therefore, equities are expensive, but compared to the last 10 years, compared to bonds, they are still in a range where I would say it's reasonably priced. In our last call, we had, are we in a bubble? And based on the slope of the curve of the indices, they are not yet going up like vertical, and therefore the final melt up is still missing. And I stick to my conclusion of that time. We still have a lot of room to go till we must call it a bubble. Dr. Copper is holding up pretty well, even yesterday. So we can make here the argument that we are in a time correction is the technical term, or in a sideways channel, a bottom building process from where we hopefully will see higher prices driven by the green revolution. One of the key elements for EVs and for all the other things with clean energy towards electrification needs a lot of copper. Therefore, we still like the metal, and I would repeat that yesterday the drop was really minor, although markets dropped dramatically. The amazing bit is the oil market. Having said several times, I do see higher prices. I can claim I was right. However, I would add, I didn't know what the reasons why we were up so, or are up so much as we are. And the reasons are hurricane. There were in the US, there was a cut in production. We have in the UK the problem that you don't even get the petrol to the petrol station. The UK and Europe has the problem that the gas from Russia mainly is not coming because we had a very cold winter, and the Russian claimed that they had to fill their warehouses. Also, the Nord Stream 2 pipeline is not yet certified where more gas would come. Therefore, you can add one and one together. the likelihood that the European Union is willing to certify the gas, the Nord Stream 2 pipeline has risen significantly. But all this disrupted a delivery chain. I have forgotten to mention the Suez problem, the tankers which are stuck in the China Sea. All this leads to shortage of supply, and the demand is rising. And the OPEC in the latest statistics said instead of having 150 million barrels more, there were actually 300 million barrels less produced, which is another explanation or the flip side of what I said before. Given the chart, given where the prices are, a mean reversion is in the card. However, midterm, the price is well supported. I would expect it to stay in the area of 80 for Brent and in the area of 76 maybe for WTI. Gold is a catastrophe. That's the short answer. Now we have at least some explanation which can make sense in hindsight. So you have a stronger dollar, you have higher US yields. Therefore, this both hinders gold to rise. If you look at the mining shares not shown here, they all look in a way that they need at least 3 to 6 months to find a bottom. So they are cheap. The production works well, but from a technical point, they will go nowhere. So I do not see a catalyst for gold. The technical picture is definitely difficult. There is not really a strong demand. You cannot make a case. So my conclusion is gold should be in a portfolio for the simple purpose of storage of wealth. And if there will be inflation over a midterm, you have a certain protection. But that's it. It's no bull case. I hope that we are well supported at the recently reached levels, but at the moment it is hard to make a bull case. Dollar is above its trend line. Here is shown the DXY index. Better growth in the US, higher yields, demand for safe haven currency will lead probably to a rising dollar forward looking. With that, I would like to come to the conclusion. So we see more and more signs of a slowdown into 2022. Therefore, areas like the ECB, the Fed, probably the Bank of England too, they are behind the curve, while in other areas of the world we have seen roughly 60 raises of policy rates. Inflation is here to stay. I said that before. Today I can add Mrs. Yellen yesterday testified that by the end of this year, inflation will be rather 4% than 2%. This is a certain admittment that it will be sticky on a higher level than previously anticipated. Having said that, I believe they knew that before. It will help them because if inflation rate is high, yields is low, you get negative real yields. Obviously, you inflate away the deficit and the debt burden of the states, also known as financial repression. We have balance sheet recession. A lot of companies are still struggling, in particular in China. Evergrande is just one of them. There are many more. Therefore, to keep this economy running, you need fiscal stimulus, which is announced in the European Union. It's going to be implemented in the US. They are at the moment debating if the second part of the infrastructure project will be implemented or not. They mixed that together with the debt ceiling, which was so far not approved. So technically speaking, it can happen that around the 20th of October, the US defaults. What definitely happens is from the 1st of October, and it's 2 days from now, there is no official budget for running the state apparatus in the States. This happened, I heard that today in the radio 99 times before. So it's nothing new. Normally, there is a disruption short term in the markets, particularly equity, but midterm, it's a no event. In the bond area, I mean, it's really hard. The highest value is in Asian bonds, but as you know, there is still a huge risk of spillover from the property area of China to other areas. Nevertheless, the Chinese government and central bank have put a lot of liquidity in the interbank market over the last 10 days. So they basically try to prevent that the market dries out. The best risk return, although the yield is still quite low, is still in the BB area. We have roughly 50 to 80 pips higher yield than we had previously. Having said that, you obviously have losses on your holdings if you were to hold them during the whole period. But if you are investing and you want some positive yield for a start, you are condemned to go down in the risk level, and normally BBB is not enough to get a positive yield. Cash definitely is not alternative. Government bonds are still no alternative. However, you get now for instance, in the Bund, something closer to zero. In some corporates, high quality, you get slightly above zero. Obviously, this is nominal yield. For a private individual, it's not attractive, but if you were an insurance or a decision maker in an insurance, you have for a start definitely a positive yield, which can help you to manage your balance sheet. But we would still avoid them. Therefore, you are basically ending up with real assets and with commodities. Mining is basically an area which protects you first from inflation partially, and second because of demand. So uranium, I mentioned the last time, there are 100 nuclear power stations in the process of getting started in the next 2 to 3 years. Copper is needed for the electrical revolution, and also industrial metals to a certain degree have profited from the recent pickup in growth. Industrial metals will be a bit trickier forward looking, but still we do not expect a recession, and we still expect decent growth down the road. Having said that, and I would bet that we will see some additional stimulus. From a standpoint where to invest, I keep being an equity bull on Europe. It's probably the third time since 2009 that I keep saying that, and the 3 times are actually, or have happened actually, over the last 2 months. US equities is definitely a place to be, although they are expensive, and for all the contrarians, Asian equities is a good place. China A shares have in September, so I'm carving out only September, but have produced in September a 0 or slightly up return. We see a sector rotation, at least in the US, so small cap and cyclicals and values, so interest rate sensitivity stocks, and last but not least also oil stocks, they have a rebound. The Nasdaq or the tech sector might struggle, but it all depends how high will US rates go, in particular the 10-year. My guess is it will not shoot above 2% because the government cannot afford to pay so much debt, so much interest on the debt, but future will tell. What we do know is that both the ECB and the Fed have in different locations stated that they are steering their bond purchasing towards the longer end, which means they steer the yield curve, and this depresses obviously the yield. Last but not least, this time I changed the motto. Buy the dip is the conclusion, and one nice phrase which summarized that is buy when there is blood in the streets. I prefer the German translation, which basically back to English translated says buy when the cannons are still shooting. However, Baron Rothschild said that after Waterloo, and the original statement goes unfortunately a bit longer, so buy when there is blood in the streets, even if the blood is your own. And it's exactly what he did. If my history memory is not completely wrong, there were paid a messenger who gave him the outcome of the battle, and then he bought when everybody panicked because he had an advantage of knowledge. So that was in a nutshell. If you want to have daily updates, in particular over the last 2 days, there were a lot of updates from the equity side, what has to happen yesterday, that today we might see not only a rebound, but we could say the technical picture is clear. We should have seen markets closing above last week's low, which has not happened in most cases. Feel free to follow us on Telegram, where this is commented. With that, I thank you all for your attention, and I open it up for questions.
This is Pavel Iliev, Andreas. Thank you very much for the very informative and helpful, interesting, engaging discussion. I have one question related to the debt ceiling in the US. We see this discussion happening from time to time, and clearly the outcome is clear. But do you see any scenarios on the outcome, or do you see it as a binary outcome? Meaning that are there any options of how the debt ceiling can change?
There are several options. I'm not the expert, but Mrs. Yellen can bridge some shortage with some market instrument. The Democrats can alone pass the debt ceiling through the parliaments, which the Republican want them to do. But it seems this is a process which takes 1 or 2 weeks. I'm not familiar with all the details. Nevertheless, that would be a way, but the Democrats obviously want it to be commingled with the infrastructure product, and the Republicans said, well, no way. We might agree on the debt ceiling, but we will never agree on the infrastructure bill. Therefore, it is really a political game. It's a dirty game. It happened last time in 2019, but in 2019, the situation was the opposite. You had the majority of the Republican, and the Democrats basically nodded their head after some discussion. This time, I'm not so sure if this will happen, or if definitely the Democrats have to pass it through both parliaments with their own votes. But for that, there is a procedure. In the meantime, they can send some people home so that they don't work, because legally speaking, from the 1st of October, there is no money to pay workers who work for the state. And there are other twists around. Eti Adeni, which I've mentioned in the past several times, who is probably 67 or so, and is a strategist for 40 years, he says, we have seen that movie before and we know how it ends. There will be some hiccups, but midterm, it will be somehow approved. Somehow we will find a solution. And for equity markets, we might see a blurb, so a fall, but that would rather be a buying opportunity.
Understood. Thank you very much.
Hello, Andreas. This is Sebastian Schmucki. One question from my side. You mentioned that for one of the first times in history, you favor Europe before the US in terms of the next few months. Is this due to the catch-up effect, or has it more to do with the sector mix of European equity? How would you, let's say, reason this change of the allocation focus?
That's a very good question. I mean, the sector mix is one thing. I mean, it's probably fair to say that there are a lot of interest rate sensitive companies in Europe. There are a lot of old technology company, a lot of value stocks. So all these sectors, if you will, should perform well when we see a rise in yields and also maybe in policy rates, although that's not really in the card for Europe at the moment. But for the first time since March 2003, there is really growth. I would add it artificially created through this fiscal stimulus program, but nevertheless there is growth, there is recovery. After a lot of hiccups, it's probably also fair to say that the Eurozone and the US, they have a vaccination rate of 70% in Europe, and in the USA it's similar. That the pandemic situation will not impact growth negatively. A wild card is Germany with the new government, but you can also turn it around. Maybe this green revolution gets now implemented faster. Germany has a lot of world market leaders in wind energy, in solar energy, so it can create growth. Germany needs to do an infrastructure program, which might be finally get on its way. Obviously, I could now start with the negative program of the Green Party and the Socialists, but let's concentrate for the time being on the positive. And last but not least, and this is nothing new, Europe is compared to the rest of the world, in particular to the US, extremely cheap. And maybe this time it's not a value trap like it has been since 12 years. Maybe this time there will be really, as you called it, a kind of catch up, because the valuation gap is not really justified between Eurozone equities and US equities, at least in comparable sectors.
Thanks a lot. And one follow-up question regarding your remark that you expect oil prices to rise further. Who do you think will be the winner, let's say, from a regional aspect as well as from a sector aspect, let's say, in the near future, or from this, let's say, energy price increase?
I mean, the short-term winners are already the traditional old-fashioned oil companies, so Royal Dutch and Exxons of this world, but also producers, in particular Russia, but not only, also Saudi Arabia and others. But Russia, you can invest. Saudi Arabia, it's at least the way I have access to it, a bit trickier. Then there is on top of it the seasonality. So we will have a normal pickup in demand for energy. And we have still the distortion in the delivery chain. So this shipping industry is A, having more than enough to ship, but B, is behind the schedule, and this cannot be really fully catched up. And also the production capacity in the US was shut down and is now restarted. So the shale gas producer is definitely a place to look at. But for this, obviously, you need to go case by case. But the easy play is, and I do know some, call it friendly competitors who bought Royal Dutch of this world with the point, they are not going really to invest. They go rather to de-invest, create cash flows, and the cash flow they will give back to the shareholders, like the tobacco industry maybe 20, 25 years ago, so that you have an even higher dividend than you used to have, and they trade at values where you can say, even if we are going to go to really to zero and will not use any oil anymore, which is not in the cards, it will take longer and we will still use it. But even in that case, you can argue that the valuation is at really extreme low levels.
Yeah, hello, Andreas. Yes, Vanya Eichel. One question from my side regarding to China. Would you stick to your statement of the blood in the streets and buying as long as the cannons are firing? Also, when we look at Chinese assets, I mean, there I often hear very different opinions. I mean, it would not be that you would not need to buy now, but maybe it could also be of advantage for investors to stay a little bit more at the sideline.
I mean, the standard Western opinion, what you find in research, in Bloomberg TV, wherever you look at, is exactly what you have just mentioned. First of all, it really depends how you get access to. On this chart, you see the green line, that's the CSI 300 index, so A shares, and it's the Shenzhen, Shanghai Shenzhen, maybe wrongly pronounced, index. Although we have seen these troubles with the crackdown in all the areas, and it was ongoing this month as well, the index is flat. So if you have access to A shares in this particular way, that was pretty okay. And the shares are cheap, and the main drivers are rather the small caps, the mid caps, nobody really knows. So if you have access to managers, which we do have on our platform, if I may add that, that makes sense. If you turn it around and you have access, or you buy the traditional one listed in the US, or the Baidu's, the Tencents, the JD.coms, and many more, over the last 3 trading days, most of these stocks have not sold off further because they are already at ridiculous low prices. We do know that China, the government doesn't want to completely destroy them. They need them. They need the growth. They need the taxes, or the donation, as they might call it. And we have also seen that Alipay and is on WePay and vice versa. So this competition which they wanted is starting to be implemented, and the companies are adapting. And the assumption of Chinese experts, which have followed 2 or 3 video calls over the last 2 weeks, they all claim similar things. We are going to see an adaptation, and they say in a second sentence, and that's actually nothing new. We have seen that at the beginning of this century, and in a lesser extent in the last 5-6 years, it has happened also there. The key obviously will be, how will they handle the disruption in the real estate sector? Will they be able that everybody who is a client at Evergrande, who has paid already in advance the flat, which is not yet built, that it will be built and that they will get it and they will not lose money? All indications we have so far point that this will be somehow managed. So local governments in provinces are forced to see if they can carve out project and give it to local provider. The loans and the interbanking system is supported. So it looks like there will be an orderly way of dealing with the situation. If you were Evergrande or a bondholder, you trade at 26 as a foreigner, and the equity price has dropped more than 90%, you will pay the bill. However, the local bondholders were served so far. Today, actually, should be the second coupon this month of international bonds. I strongly assume they will, like last week, not pay, but they still have 27 days plus minus to fix that. If not, they will technically default on the international bonds. Also, that is at the moment to a certain degree expected. So to cut the long story short, what happens in the next 3 to 6 months is extremely difficult to foresee. If you are buying China, get access to A share and be prepared that this holding must be held at least 12 months. If you do so, and the access vehicle has access to the broad spectrum, so not just to the in Western world quoted large cap tech companies, but to the for us unknown smaller companies, which are the backbone, by the way, of the country, then I'm pretty sure you get rewarded. It can be a valley in the meantime. Obviously, I cannot rule that out. Evergrande is still up and running and struggling. It's not solved. A lot can happen, but I'm really taking the bet that over 12 months in A shares, you get rewarded.
Thank you very much. And maybe another question of something that was now not covered within the call already, but if we look at the crypto market where investors are very interested, also is the air out? Is this cycle already finished, or what is your opinion on that?
I mean, the easy answer would be I have no opinion, but it's not what people want to hear. There is an interesting discussion between a famous Swiss, actually German, but teaching in Switzerland, behavioral finance professor, and a guy who is in the crypto area. And the professor claims there are a lot of possible earthquakes, accidents ahead of us. One has already happened. So in China, it's now completely illegal to use Bitcoin, to mine Bitcoins. But as this is a decentralized system, the mining process, as I've read, has moved out of the country. I would argue that the people who were mining in China probably are still in China, and the business moves probably somewhere else. The professor also claims that the speculators are out. I would disagree. I don't think so. The interest has moved on a bit to Ethereum and Ripple and others. There are also stable coins. If I look here at the chart, you probably can see from a technical point, we are consolidating on the 100-day average. The only thing I dislike is that we might see a dead cross, so the pink line crossing the yellow line. But that's completely open. If you talk to people who are in the market and invest for a long time, they obviously have a complete the opposite opinion. I would argue that it's a question of time till we see the next spike up in Bitcoin and probably with it in other markets. The key question is the intrinsic value of Bitcoin is zero, but that's not the point. Will investors be able and willing for in the future still pay at the moment 42,000 for something which is basically computer code? That's the key question. It looks like yes, but history will teach us this lesson. Therefore, short term, you see here a chart. The hype has a bit gone, or you can also turn it around, like for equities. This is a sideways correction. We have broken up and are now testing levels we have seen in June, as you see in this chart. If it doesn't fail, there is no reason why it shouldn't go up like this Bitcoin forecasters say, to first through 60, 65,000 and then even double. So future will tell. I think I do not see any questions further. So I thank you all for your questions and for your attention. Hope to see you next time, and feel free to join us on our Telegram channel. Thanks a lot and goodbye.